Well, good morning, West Coast, and good afternoon to the East, and good day to everybody in between. My name is Brad Etheridge. We're pleased to have you with us here today. For those of you that don't know about the center, we are not an IMO or a PPO or a broker-dealer. We're a membership-based organization. I guess probably the best way to view us is to kind of see us as a study group on steroids. But the center itself creates a level of education and differentiation for advisors. We have as members, we have some CPAs, we have some tax attorneys, we have a lot of financial planners. We've got some folks that are asset gatherers or just pure life insurance agents. And one thing they have in common is they want to be able to provide better solutions and opportunities to their clients through strategies, concepts, techniques, and training that they otherwise would not have access to. So the center itself is providing this free webinar today. We're going to tell you about an event we have coming up that could be career changing for you. We'll talk about that in a few minutes. But before we do that, I want to introduce Simon Singer, who is the founder in the Center for Tax Strategies and Resources. For those of you that don't know Simon, he's been very successfully in our industry since 1966. He's in the top 1/10 of 1% of all financial planners in the U.S. And has been for years and years and years. He's written several business bestsellers. He's quite a sought-after speaker when the world allows us to speak publicly. And he has been a member of some very prestigious organizations such as Financial Planners Association, Advisors in Philanthropy, and is the past president of the Forum 400 and is the National Humanitarian Award recipient, which is quite an honor. One thing about Simon, I'll tell you that you wouldn't know from his bio, he lives for this stuff. I have never met anybody who's better getting a client to disclose more information and eventually look over to you and say, well, why wouldn't I do this? And that's usually his biggest closing line. So with that, Simon, say hi to everybody.
Thanks, Bradley. Appreciate the kind words. Always do. Our next speaker is going to be a tax attorney extraordinaire. He's spoken for us before, which is always a great pleasure. His name is Bruce Gibner. Bruce is one of the preeminent tax attorneys in the country, let alone Los Angeles. He and I have worked together for the last 30 years. I have never run into a tax attorney that was more solution-oriented than Bruce is. He's going to talk to us about how using life insurance properly with the help of an extremely talented tax attorney can help to solve capital gains tax planning, tax for income and businesses, income tax planning for retirement plans, estate and tax planning, and even pre-immigration planning. So at this time, please join me in welcoming my friend, Bruce Gibner.
So the purpose of this presentation is to let you all know that life insurance can be the answer to most tax planning issues, whether it's capital gains tax planning for the income from a closely held business, taxes from a retirement plan, definitely estate taxes, and I'm going to mention pre-immigration planning, which doesn't come up very often for most people, but just to tantalize you with it for a minute or two. So that's the purpose of the conversation, is to show you how you can use life insurance to solve most income tax and estate tax issues. And that is a way for you to make money, okay? Now, in this presentation, I'm not going to try and teach you every detail of each technique because I don't want you to go around trying to sell techniques. That's not your job. You're not tax lawyers. But I want to open your eyes and open your minds to the possibilities that you can use a life insurance and make money in virtually every tax planning issue that arises. So the introduction, which you see the 4 tax shelters, and I'm not able to show you, but I think that Todd and Brad and Stuffy can send you my article from Limeberg, which is entitled The 4 Tax Shelters, because that's how I introduce planning to clients and referral sources, is to say that when you hear the phrase tax shelter, it usually has a negative connotation to it because people think of offshore trusts set up in the Cayman Islands where people put assets or money, and they don't pay tax on the income from those assets. That's tax fraud. I just got off of an IRS webinar this morning on promoters, and the IRS has an office of promoter strategies. And they mentioned, for example, the monetized installment sale, which Stan Crow created about 7-8 years ago. And the IRS no longer likes or doesn't like monetized installment sales. Obviously, syndicated conservation easements, the IRS has indicted a number of those folks. They don't like the Malta pension plan, even though we got very good opinion letters from very big law firms for our few clients who went into it. So you think of tax shelter as a pejorative term, but the idea of shelter itself, there's nothing bad about that. It's like a roof that you put over your head to keep out the rain. So there are 4 tax shelters that are legal and ethical, and everybody should understand that there's nothing controversial about those 4 shelters: pensions, charities, charitable remainder trusts, and life insurance. So all 4 of those, pensions, charities, charitable remainder trusts, and life insurance, have one thing in common, which is the assets or the money inside of them are not subject to income tax. So the assets inside of them grow income tax free. Nothing controversial about that. The IRS would not disagree with that. The first 3, pensions, charities, and charitable remainder trusts, have something else in common, which is all or a portion of what goes into them, you get a deduction for those assets or money that go into them. The 4th one, life insurance, you do not get a deduction for any premium paid on a life insurance policy. If you buy a policy inside a tax qualified retirement plan, like a profit sharing plan or defined benefit plan or 401k, yes, you're paying the premium with dollars you've already deducted, but that's not the same thing as getting a deduction for paying a premium. So life insurance, you don't get a deduction for paying the premium. However, life insurance has an advantage the other 3 do not have, which is that all the ways money comes out of a life insurance policy are tax-free, whether it's the death benefit, which is under section 101, parenthesis little a of the Internal Revenue Code, or the borrowings on a policy. Well, there's never tax on a loan. So one of the roles of a tax lawyer is to help clients get money or assets inside one of those 4 shelters, legal and ethical shelters. So we're going to focus on life insurance because that's the way a lot of you, if not most of you, make your money. So we're going to talk about capital gains tax planning, something you probably did not know you could do with life insurance. We're going to talk about tax planning for the income from a business, something you may have thought you could do with the restricted property trust. I don't think that's ever been true. The person who put it together cited the Mann case, which has really nothing to do with the merits of the restricted property trust. Income tax planning for retirement plan. Well, there's been various ways that life insurance has been thought of as a way to reduce the tax on retirement plan income, but I'm going to describe a couple of ways to do that you might not have thought about. And estate tax planning, obviously the most common usage of life insurance for estate tax planning is to pay the estate tax, and that's not what we're going to discuss. And a lot of you may already understand generational split dollar. I'm going to try and make it easier for you to understand. And then pre-immigration planning, which doesn't come up often, but when it does, the use of life insurance in connection with it is really a wonderful result, which I think you'll like. So let's talk about capital gains tax planning. And by the way, if you have questions, please send them in. And I like to take questions during the presentation, but if that doesn't work out for Brad and Todd and Stuffy, we'll take them at the end, and I'll answer all of them. So with capital gains tax planning, we sort of divide, well, actually there's 4 criteria that we use in deciding among the at least dozen ways to reduce, defer, or eliminate capital gains taxes. Those 4 criteria are timing, which is the most important, certainly, because the farther in advance you do the planning for a capital gain, the more conservative it's going to be, and you're going to have more alternatives. So timing is probably the most important. When people come to us in 2022 we want them to be talking to us about a gain that will occur in 2023 or 2024. We don't want them coming to us in 2022 talking about a gain that will occur in 2022. That's just not going to be very good, because the IRS, and if you're in California, the Franchise Tax Board have techniques they can use to challenge that planning. The assignment of income doctrine, the step transaction doctrine, substance over form, lack of business purpose, lack of economic substance. But if you set up the structure in 2022 and the sale doesn't occur until 2023, or better, 2024, the IRS is less likely to be interested in challenging the planning that you do. So timing is number one. Number two is the size of the gain. And the reason for that is a lot of the techniques deal with the installment method of accounting. And there's a limit of 5 million per person on how much of an installment sale you can do per year. Number three is the nature of the asset. A lot of the assets are non-transferable, like warrants or stock options or medical corporation stock. S corporation stock has its own problems. C corporation stock has its problems. So timing, size, nature of the asset, and the speed of the increase in the value of the asset, and that's what I'll focus on right now. If you have an app where the client comes to you and says, you know, my business is worth $10 million, and next year it'll be sold for $50 million, that's what we refer to as an asset that will skyrocket in value. But a lot of the times, and life insurance is very, very helpful for that situation. But a lot of the times you have someone that comes to you and says, my business is worth 10 million. I think it will sell for a lot of money next year or the year after, but I'm not certain. So nonetheless, you can use life insurance for that kind of fact situation. So I'm not going to cover every single use of life insurance for capital gains tax planning, nor am I going to cover every single capital gains tax planning alternative. And I'm not referring to 1031 exchanges, and I'm not referring to charitable remainder trust. Everybody sort of knows those two. So if you have an asset that's going to skyrocket in value, there are 6 very easy steps to this technique, which I invite you to write down. But again, don't try and teach this to your clients, because questions are going to arise and you're not going to be able to answer those questions. What you want to be able to say is, hey, there's at least 1 or 2 or 3 structures in which you might be interested, and I can get you to an expert and we can discuss them, and you might like the results. Bring your CPA along also, if that's the person on whose advice you rely. So here's the 6 easy steps for the person who says, my business is worth 10 million today, and I think it'll sell for 50 million next year. Step 1, you appraise the asset. The asset appraises in our example for 10 million. Step 2, you create and appraise an option to buy it for 110% of today's value. So that would be 11 million, and we call that the strike price. Step 1, you appraise the asset. Step 2, you appraise the option. What's the value of an option to buy that at $11 million at any time, let's say in the next 2 years? So I'm making up a number. I'm going to say the value of an option to buy it at 11 million anytime in the next 2 years is $1 million. Obviously, I have no idea what the value of the option is, just using $1 million as an example. Step 3, you create a complex children's trust. Complex means the trust pays its own taxes, meaning it's not a grantor trust, it's not disregarded, it's not what some people call an intentionally defective grantor trust. So that's step 3. Again, step 1, you appraise the asset. Step 2, you appraise the option, which we said is worth $1 million. Step 3, you create a complex children's trust. We're halfway done. Step 4, you give the option worth $1 million and $1 million of cash or a diversified portfolio of publicly traded securities to the children's trust. That's step 4. We're 2/3 of the way done. Step 5. Now life insurance makes its appearance. Step 5 is the children's trust pays the $1 million option and the $1 million of liquid assets to an insurance company as a premium on a life insurance policy. Well, we know it's not going to be a retail insurance policy because, Mass Mutual is not going to accept an option as a premium on an insurance policy. But there are private placement life insurance carriers who will accept non-cash premium payments. And by the way, private placement life insurance is not some weird vehicle. There are very big insurance companies like Pac Life who sell, and Hancock, who sell PPLI policies. So let's review. Step 1, appraise the asset. Step 2, appraise the option, which we said is $1 million. Step 3, create the complex children's trust. Step 4, give the option an equivalent amount of cash to the children's trust. Step 5, the children's trust pays the option and the cash as a premium on a policy. There's only one more step, and that's step 6, where mom and dad get $50 million for the business. Well, as soon as mom and dad get to step 6, where they get $50 million, the option, which is owned by the insurance policy, gets exercised. So mom and dad get $50 million, but they only get to keep 11 because that's the strike price. The other $39 million has to get paid to the insurance policy pursuant to the options exercise. Mom and dad get a deduction, it's actually a short-term capital loss, for the $39 million. They don't pay tax on the $39 million. And of course, the insurance policy doesn't pay tax on the $39 million. That's the entire 6 steps. So why did we do that? Well, number 1, they don't pay tax on the $39 million. Number 2, let's say the $39 million invested in the policy earns $2 million. Well, as you know, there's no tax on the earnings inside an insurance policy. So that's benefit number 2. Benefit number 3 is the children's trust borrows the $2 million, no tax on that. And the children's trust loans the $2 million to mom and dad, no tax on the loan. That's the 3rd benefit. The 4th benefit is, let's say mom and dad survive for another 20 years. Well, they die owning 20 years times $2 million is $40 million to the children's trust. That 40 million offsets 40 million of value in their estate, saving the children 40% of 40 million, which is $16 million in estate taxes. We could talk about it longer, but that's the structure. It's very nice if you have the right set of facts. What's another use of an insurance policy?
Bruce, they would pay tax on the 11 million though, the capital gains tax on the 11 million, correct?
Thank you very much. Yes, they have to pay tax on the strike price stuff. Yes, it doesn't make, thank you, it doesn't make the tax on today's value plus the 10%. That's the 110% strike price. They do have to pay tax on today's value. Thank you.
Yeah, so in California, you saved them 33% on $39 million, and it continues to grow income tax free and all the regular benefits of a regular insurance policy, right?
You betcha. And we don't have to go through who's the insured, who's the carrier. Those are details that can be filled in later. So let's go to another use of life insurance in connection with the sale of a business, capital gain. You still use an option. Let's say the business gets appraised at 10. Let's say the strike price is 11. And what you do is you put the option and the $1 million, although I'd probably put a little more, but let's just stick with the $1 million. And it makes its way down into the insurance policy. What we do is we get an appraisal of the business at the time when the value is, let's say, $12 million, okay? And at that point, the insurance policy buys the business for 10% down. I'm rounding, obviously this is not correct, $1 million down and an $11 million promissory note. Now, there's things you have to do because of something called the investor control doctrine. But basically what you've done is you've set up mom and dad so that they have a promissory note. At some point in the future, the business is going to get sold. Let's say it's sold for the same 50 million. Well, the 50 million comes into the insurance policy and mom and dad have an installment note. Now, you don't want to do that again in the same year as a sale. But if you do it a couple of years before a sale, it's a nice way to lock up the 50 million in the policy. And mom and dad now just have nothing but an installment note, and they got the $1 million down payment. So I'm done just trying to open your eyes to the fact that you can use life insurance thoughtfully and conservatively in connection with the sale of a business, okay? So let's move on to tax planning for the income from a business on an ongoing basis. So let's consider this fact situation. Let's assume mom and dad have a business that they think is going to make $5 million a year going forward. Okay. So what we have to do, you'll see the first item says create a counterparty. So what we do, it's going to sound like the prior example. Mom and dad create a complex children's trust. They put millions of dollars, it's going to depend upon the facts, into this complex children's trust. The complex children's trust is going to put almost all of that money into an insurance policy. And the insurance policy is going to put most of it into a single member LLC, which I'm just calling our counterparty. Okay. So on the left-hand side of the sheet of paper, you've got mom and dad who own this business, which they think is going to earn $5 million a year going forward. And on the right-hand side of the paper, you've got the counterparty, this single member LLC. And the counterparty says to mom and dad, hey, I know you think you're going to make $5 million a year going forward. However, there's some uncertainty, isn't there? You could have a new competitor enter the marketplace. You could get ill. You could lose a vendor. You could lose a supplier. The economy could go into the tank. So the $5 million a year isn't guaranteed. And mom and dad say, well, you're right. It's not guaranteed. It is speculative in some respect. And the counterparty, the single member LLC owned by the insurance policy, says, hey, how would you like it if I can guarantee you a certain dollar amount each year for, let's say, the next 7 years, and I will take the income from the business in exchange for that guarantee? Mom and dad say the only thing that makes any sense, which is how much is the guarantee, right? Because it's a question. So the counterparty says, I'm not sure. Let's hire an appraiser. So what does the appraiser do? The appraiser values the business. So let's say the EBITDA, again, I'm making up these numbers just so I can explain the concept. The appraiser says, well, $5 million a year, 6 times EBITDA, it's worth $30 million. Okay. Then the appraiser comes up with a discount factor. Let's say, and by the way, the lower the discount factor as a percentage, the better this is going to work out for mom and dad from a tax planning point of view. The higher the discount factor, the less attractive it's going to be. I'm going to make it 10%, which is very, very high. We never get to 10%, but I want the math to be simple. So 10% of 30 million is 3 million a year. So the counterparty says to mom and dad, based on the appraisal, I will guarantee you $3 million a year. And let's just say that mom and dad said, okay, we'll give you the income from the business for the next 7 years in exchange for an absolutely guaranteed $3 million a year. That's the entire transaction. So in terms of having economic substance, it's got real economic substance because they're trading an uncertain future cash flow for an absolutely certain cash flow of $3 million a year.
Thank you, Bruce. That was great as always. Let me just review for you how this is meaningful to your net practice income, because I've been doing this kind of stuff with Bruce for years, and I will tell you that some of the cases that I've been able to close, there isn't a chance in hell I would have been able to close them without a tax attorney on my shoulder. Because as you might well imagine, whenever you get into sophisticated areas of planning, the client is going to go talk to somebody. Could be his CPA, could be another tax attorney, could be a friend of his who's a divorce attorney, but they're going to talk to somebody. And so having high-level counsel along with you to offset any of the negatives that some people call deal killers might have is extremely valuable. So for instance, when you're doing capital gains tax planning, there's, depending on the size, and typically because there's pretty substantial legal fees involved, you don't want to do it for somebody who bought a house for $40,000 30 years ago, and today it's worth $500,000. The fees are going to grotesquely offset that. But if you're going to do something like giving a piece of real estate or even a business to a charitable remainder trust, for example, well, if you've got an asset that's worth $2 or $3 million, what you're doing is you're taking that asset and its growth away from your family. However, in exchange, you pretty much eliminate long-term capital gains tax on the sale. So let me just use a round number. So I've got an asset that's worth $1 million today. And let's say I bought it for $1, just to make the math relatively simple. So I've got an asset that's worth $1 million today, and I'm going to give that asset to a charitable remainder trust, and eventually it's going to go to a charitable institution of my choosing. Therefore, my family is not going to get that $1 million. My family is not going to get the growth on that $1 million, but in exchange, I eliminate long-term capital gains tax on the sale of that appreciated asset, number one. Number two, I get a current income tax deduction depending on my age and the term of years of the CRT. Let's say the income tax deduction is $400,000 and I'm in a 50% tax bracket, so I save $200,000 in taxes. So tax saving number one, long-term capital gains tax. So in California, that's 33% on $1 million, that's $330,000. Then I get a $400,000 income tax deduction that saves me $200,000. Now I'm at $530,000. And oh, by the way, that asset is now outside of my taxable estate. So my family doesn't have to pay 40% in estate taxes. 40% of $1 million is $400,000. I'm now at over $900,000 of tax saving, which is nice for me while I'm alive, but my family doesn't get the $1 million. So do you think it's possible that I could take the $900,000 of tax savings and buy $1 million insurance policy? You bet it is. Well, how about instead if I take the earnings of, let's say, 5% on $900,000? That's $45,000. I can more than likely buy $1 million either single life policy or second to die policy for $45,000 and generate compensation for me along the way. And it's quite possible that it might even be able to buy $2 or $3 million. So that's the issue of what's in it for me, meaning why do I just want to do tax planning? I want to do tax planning because it's good for the client, it's good for the family, and oh, by the way, it's good for me. And the same thing holds true for tax planning on income or businesses. And let's talk about income tax planning on retirement plans. Well, first and foremost, people have to understand that if they've got a couple of $1 million in there, and they're in an estate tax bracket, which means in today's world, they've got to be worth more than $12,400,000. And for a couple, roughly $25 million. That doesn't fit a lot of people, but let's assume that it does. In the first place, everything that's in the retirement plan is going to be subject to income taxes. Income taxes for everybody. And if I've got $1 million in the plan, I'm probably going to wind up paying income taxes over my lifetime. Let's say from age 60 to age 100, just for argument's sake. I'm probably going to wind up paying about $800,000 on just the required minimum distribution, $800,000 in income taxes over the years. And we've got software that can illustrate, and you can look for yourself and see that what I'm saying is correct. In addition to that, however, if they die prematurely, there's another couple of $100,000 left in there, and that's another $80,000 of estate taxes. So the family's going to wind up receiving net, maybe $200,000, and the federal and state taxing authorities are going to wind up with $800,000. So in exchange for that, what we can do, especially if they don't need the money to maintain their lifestyle, we can probably produce a $2 or $3 million income tax-free life insurance policy, income tax-free, and then we have to do some strategizing to get that insurance policy outside of the taxable estate, but we can do that, in which case they're going to receive $2 or $3 million net after income and estate taxes, as opposed to $200,000. The arbitrage by knowing how to use the opportunities in the tax code are just monumental. But I will tell you, you're going to fall on dead ears unless you do it with highly qualified tax counsel. Let's see what else we got. Pre-immigration tax planning. I've never done that. I don't fully understand how that works. My guess is it involves a private placement life insurance contract, of which I'm a very naive, almost infant in that area. So don't feel bad if you are, because I will tell you, if you can generate revenue for the tax attorney and the CPA with legitimate, honest, ethical planning, they will be the best advocates that you have. So that's a brief overview of what Mr. Gibner talked about. Unfortunately, we don't have the time in this venue to be able to produce all the things that Bruce Gibner knows how to do. But let me just suggest to you, you can't just hear this stuff once. And Bruce is going to talk about not only this at the Academy, but he's going to talk about many other variations to do exactly what we want to do, which is have people purchase life insurance that's going to help their overall family and their tax situation. And here you got a tax attorney talking about that. So if I were you, I would, I mean, Brad's going to tell us more about the Academy later on, but I would go and get the discounted prices as they last, because there's a substantial amount of information from all of our presenters, not just Bruce Gibner.
This seemed like a pretty good place to let everybody know about our upcoming Academy event, which is going to be virtual. So this will be, you can do this right from the comfort of your home office or any electronic equipment. You can broadcast and you can watch this technically from the golf course. But we have an Academy coming up here. I want to tell you a little bit about what is going to happen over those 3 days. We have our faculty, which are our experts that our members all have access to as part of being part of the group. But we're going to bring in these experts over this 3-day period, and they're going to cover some amazing topics that can just be incredible. If you're not watching this at the event and have a notepad where you end up with 10 names of clients that you could apply that to, I'd be shocked, because nobody ever does less than that. Just a great way to really enhance the tail end of your year here and get you ready for year end. It should be one of your best times of the year. So this Academy starts at 8 o'clock in the morning Pacific and ends at 3. We do about a 20-minute break for lunch in between for returning phone calls. If you get into the virtual Academy, the guests, the folks, those of you that aren't members, will have a week to be able to review the material. It'll be recorded, so you can go back and play over any of those parts as many times as you want. For the members of our group, by registering for the Academy, you have unlimited access to the recordings in perpetuity. Now, our members pay less than the general public. You can find the registration for this. In fact, we'll send you a link as soon as this is over also, but you can find our registration at www.yourctsr, your Center for Tax Strategies and Resources.com, and click on the upcoming events tab. Again, members, make sure you're going to the member portal and then register from there. If you need more information on what we've talked about today, or you just need some more information on why you want to become a member of our group, you can call 877-258-2837, or you can email the center team at YourCTSR, and we will put this up again at the end of the program.
Our next speaker is going to be Dr. Vicki Rachner, who's been with us before. Vicki is a certified board surgeon who about 15 years ago decided to go to our dark side and start to try to help doctors, her compatriots, who do a really lousy job of managing their income, managing their taxes, managing their investments, stop trying to invest in restaurants, because that seems to be a really favorite thing of doctors, and instead started to study doctors' habits, doctors' language, how they make decisions, how they invest, who they listen to, why they listen to them, how to gain credibility, and basically how to talk a doctor's language, which is basically what's called white coat language versus suit language, which is what we all dress in and how we talk to each other. What's interesting is that coincidentally, many years before I ever met Dr. Rachner, I wound up getting half a dozen doctors who were all participating in an entity that eventually went public and was acquired for many billions of dollars. So the doctors became very wealthy. And I was well introduced. I was introduced by a CPA, introduced by a tax attorney. Every one of the doctors we talked to, I think 7 of the 8 board of directors became our clients. Every single one of them shook their head affirmatively, basically said it really sounds good, but we want to talk to our CEO, who was also another doctor. And what Dr. Rachner talks about in her study groups, in her books, is doctors listen to other doctors more than they listen to anybody else. So one of her messages is going to be, how can I get more doctor clients? Why do I want more doctor clients? How do I create the right environment to a doctor so they don't just blow me off because they think I'm just another salesperson? Many of the wealthiest clients that I've got, not all, but many of them are doctors, and by chance, I happen to be doing the same things of which she's advising people to do proactively now, as opposed to just hit and miss. So I would strongly suggest you pay attention to what Dr. Rachner has to say. It's not technical, but it is very psychological, and it's something that everybody can learn how to do. At this time, please join me in welcoming Dr. Vicki Rackner.
Saying this to, boast, but rather to make a point that understanding the differences between you and your mindset and your perspective and your buyer's mindset and perspective is important. And this is particularly important if you want to work with doctors. When I see financial advisors struggle to acquire doctor clients, I sort of feel like saying, I feel your pain. I was there. I was a doctor trying to cross over the bridge from the world of medicine into the world of business. And man, I just didn't have the right tools. And so crossing over from the world of business into the world of medicine is unique also. And this is what I do. I translate these worlds. I offer this bridge so you can cross over and sort of act like a native in the world of medicine. And by the way, this bridge between the world of business and the world of medicine works in two ways, right? So I work with financial advisors who want to work with doctor clients through my brand, Engaging Doctors. But I also help doctors go from the world of medicine into the world of business. And in this presentation, I'm going to show you exactly how and why this is so important. Okay, well, is this just my experience? Am I just a unique person that had problems making this transition? I'm going to argue no. If you've tried to work with doctors and you are struggling, this is probably the reason why. I'm willing to bet a dinner on it. And let me just show you an example of how this works. So I love Shark Tank. I consider it part of my ongoing business education, so I watch regularly. A bunch of years ago, a doctor went into the Shark Tank to get funding for his company, Syndaver. He sold synthetic cadavers. This is about $1 billion industry. He already had millions of dollars in sales. The sharks were all really engaged. And I thought, man, this guy is going to get a 5-shark deal. But then the question started. Mr. Wonderful said, well, tell us about your revenue. Tell us about your profitability. And there on national TV, this doctor said, well, the honest truth is that profitability really isn't that important for me. I'm here to make a difference. And with that kind of answer, 4 sharks were out. He got a deal with Robert Herjavec, which fell apart in a couple of weeks. Okay, so what went wrong here? What went wrong is that this doctor entered the Shark Tank. His buyers were the sharks, but he didn't get into their heads and understand what the sharks want to know is how their money is going to grow, right? And the doctor said what was important to him. It was making a difference. Okay, so now let's imagine there's another reality show called Surgeon's Lounge. You walk into a room, there's 5 surgeons sitting in plush leather chairs. You want to get a deal with as many of them as possible. If you go in talking about numbers, talking about retirement, you're probably going to get the exact same reaction that the doctor got when he entered into the Shark Tank. This is not what's important to doctors. So truly understanding what's important to them can transform your results. If you go to the Engaging Doctors site, you will find lots of testimonials of financial advisors who were able to make this mindset shift to use the right tools and be able to successfully engage doctors. Okay, well, you might be wondering, it's so much easier to just work with small business owners or maybe CEOs of large companies. Why in the world would I want to add this layer of complexity to my life and to my business? And here are some business reasons that you might want to think about it. The first is Sutton's Law. When Willie Sutton was asked, why do you rob banks? He said, that's where the money is. And if you look at where the money is for you, it's in the medical market. There's about 1 million practicing physicians and 200,000 practicing dentists in the US. According to the US Department of Labor Statistics, 10 out of 10 of the top earners in the US call themselves doctors, and about 40% of doctors are age 50 or older. And as you know, assets grow as you get older. But here's the biggest number. Every year, doctors are asked, how prepared for retirement are you? And year after year, the number is constant. Half of doctors self-report being behind in retirement planning. But the fact that this number doesn't change means that the awareness about the lack of preparedness does not inspire action. Why? It's because doctors don't like thinking about money. They don't like talking about money. And what I'd love to do, and we can make this happen later, is I'd love to share with you my books, The Myth of the Rich Doctor and the 9 Money Mistakes that Doctors Make. Now, these are books for doctors written peer-to-peer to them. So I don't offer any financial advice, but what I do want is for doctors to reinvent the relationship with money. Replace the judgment and embarrassment and shame with insights about why they make the money choices that they do so that they're in a better position to work with you. And I really do invite you to read them. They're quick reads, so I won't review the stuff that's in there. But doctors need you. Many doctors will be economic slaves to their practices well into what they hoped were their golden years. In fact, the AMA is so concerned about this that they have decided, we should do something to make sure that doctors are really competent to practice medicine as they age. I know that one hospital, very famous hospital, had an OBGYN with a gambling problem. So he was working into his 70s. And this institution just bought the doctor an annuity. They figured it was cheaper to just buy the annuity for this guy than take the medical legal risk of what could possibly happen if he continued to deliver babies. Okay, another great reason to work with doctors is that doctors are very, very loyal clients. So with the ultra high net worth, you know that client acquisition is not as much of a problem as client retention. When you talk about doctors, you turn that relationship upside down. The barrier to entry in the medical market is very high. And what I'm here to do is to lower that barrier to entry. So the barrier will keep out your competition. But once you have a doctor client, they will probably be your client for life. You can make mistakes. They will not tolerate lapses of integrity or lies. But as long as you conduct yourself with integrity, you will have these clients for life. But here is the best reason to do this. Doctors gossip, kind of like teenage girls. If you could be a fly on the wall in the doctor's dining room and the surgeon's lounge, you would find doctors sharing resources. Now, with doctors being virtual, now doctors are getting into online communities and gossiping. Believe it or not, the main online platform for doctors is Facebook. And the reason for that is because Facebook allows you to form these private groups. In order to join the groups, you have to prove that you're a doctor, tell them, when you graduated from medical school, show picture ID, because they don't want patients eavesdropping on their conversations. So this is where a lot of the conversations are happening. And if I were to share my screen and take you into these groups, you would find doctors asking questions like, well, what kind of insurance do I need? And, I heard about this thing about, life insurance and premium financing. Like, is this just a scam or is this the real deal? And doctors are asking other doctors. They're not asking you. Okay, but here's the deal. I have one client who saved an orthopedic surgeon over $900,000 in taxes in a single year with strategies that Brad and Simon talk about. Well, what do you think that orthopedic surgeon is going to do once he gets into the doctor's dining room or surgeon's lounge? He is going to boast about his big win. And now what do you think those other doctors are going to say? Hey, do you think this guy could save me some taxes? And this is an excellent way for getting word to spread about you. Now, this is another example of the differences between suits, people like you who are native to the business world, and white coats like me, people who are native to the world of medicine. In the world of business, you want the competitive advantage, right? Financial advisors don't like sharing information about me. They don't want their colleagues knowing how to overcome the high barrier of entry in the medical market. They keep the best ideas for themselves. Doctors, on the other hand, when they hear something good, the very first thing they want to do is share this with others. So think of your doctor prospects and clients as your auxiliary sales force. What you want to do is empower them with the language to go out and describe to other doctors exactly how you improve their condition. So when I work with my clients, one of the first things that I help them do is to craft their positioning statement. And it's pretty simple. I help this group of people to achieve this outcome. I help orthopedic surgeons in private practice legally and ethically lower their tax bills so they can put more money in their pockets. Okay, so this is not created so that you can, meet a doctor at a networking event and, tell them what you do. The reason that you have this positioning statement is so that doctors can describe what you do to other doctors. So the single most influential person in a doctor's life is another doctor. So you can talk with doctors about the potential value of your wealth building strategy until you are blue in the face. You can bring out graphs and charts, and you know what? Doctors don't care. What they care about is, oh, are there other doctors doing it? And so really, the most compelling way to persuade doctors comes from the pharmaceutical industry. They have the most expertise in persuading doctors' purchasing decisions. And what do they know? They know that you've got to expose the doctor to a message between 7 and 10 times before they take action. They also know that if they are going to launch a new medication, what do? They find the key physician opinion leaders. And when they are in front of a doctor, they say, hey, do you know that all of these doctors are prescribing this new medicine? So doctors want to be like other doctors. And so when you recruit doctors to your team, and you can do that in all sorts of ways, have a doctor on your advisory board, empower your doctors to talk with other doctors in the surgeon's lounge or doctor's dining room, maybe make an introduction so that you can deliver a presentation to a doctor's group. This works great. And this leads to what I call the escape velocity. So I was talking with one of my private coaching clients. We were working on this new marketing campaign. And I always like to tailor the marketing campaigns to what the advisor really loves to do and what their gifts are. Okay, so this advisor is just an extroverted charmer, right? So what he loves to do is he loves to take a group of 6 or 8 doctors out to dinner. So he and his wife will.
Thanks, Dr. Rackner. As usual, that was more than beneficial. I know that I've benefited dramatically from what you teach people who take your classes, from people who participate in your books. And if I remember correctly, you're even available to speak at organizations or help our members get into those various organizations that cater to doctors of all types. We just finished doing a couple of veterinarians who, by the way, happen to have very successful practices. They're not yet being gobbled up by the big entities that are gobbling up all kinds of doctors' firms. But let me just kind of restate what's in it for you. In the first place, doctors don't do very good tax planning. They're waiting for the next time when their CPA calls them with a piece of prospective information to help them save taxes, number one. Number two, doctors are concerned with their net practice income because it keeps dropping as the insurance companies get more and more involved. So it's really important to first know what the doctor needs to maintain their lifestyle, and don't believe them when they tell you we spend everything we make, because if they did, that means they wouldn't be paying any taxes. They would be sending that off to the federal government as well. So the reality is sometimes there is an excess in budget, and it's the excess in budget that we can do planning with. So whether it be a defined benefit plan or a cash balance plan, they're being educated now falsely by saying, well, all that is a deferral, because you get an income tax deduction today, but you're going to have to pay ordinary income tax tomorrow, which is probably going to be larger because your distributions are going to be larger than your contributions. Well, there are some strategies, once again, utilizing tax attorneys, once again, using the psychology of language and positioning with doctors, whereby you can have maybe 30, 40, maybe even 50% of the money come out of the retirement plan on an income tax-free basis. And that's by using specially designed life insurance contracts paid for inside the retirement plan, discounted at maybe 50% when they get the policy out of the qualified plan. So pre-tax dollars going in, discounts on the way out, and then tax-free income. So maybe for 10 or 15% additional contribution, they can include an investment grade insurance contract. Ours typically are averaging between $50,000 and $150,000 of annual commissionable premium inside of qualified plans. But we've got to get a doctor to listen to us first. Let's see, what else? The wrong approach. Doctors are much more into feel and touchy stuff as opposed to technical data that you stick in front of them that you think that because they're scientists, they're going to want to read. They don't understand our language. They understand their language. We don't understand their language. So there's a not quite a meeting of the mind, but whether it be pension rescue, pension contribution, I know I can say to most any wealthy person, doctors included, doctor, now that you're in the distribution phase of your life, which is more important to you? More assets on your balance sheet or guaranteed income? And if they think about it, they're going to say guaranteed income because they don't get to spend assets on their balance sheet. It's just an important flavor to be able to know how to talk to different types of people, and doctors fit into that category of different. So it's really important. I would strongly suggest that you take a look at her books. I'd strongly suggest that you take her course. It's a few $100s for each, but look at it as an investment, because that's what it is. And the reason we keep having her back is she brings results to the table for our members. You know, another thing of interest is, you know, Dr. Rachner could probably talk to us for a week on the psychology of working with white coats or doctors. So I would make certain, if for no other reason than Dr. Rachner's influence, is to make certain that you attend our virtual academy, the CTSR virtual academy, from 8 o'clock in the morning to 3:30 Pacific time. Times are approximate because sometimes we run over. So, you know, we've got 20 hours of education, motivation, marketing, solicitation, language, strategy. It's a pretty substantial 20 hours of educational material that you're not going to get anyplace else. And I think our members already know that. The non-members, if you haven't experienced this, it's less than the cost of a weekend in Palm Springs. If you want to register, you go to our website at www.yourctsr.com. Members, if you want to get the discount, you've got to log in under the upcoming events tab. That will automatically take and lessen your price down to $99 for members. So there's no sense in spending extra money for the same thing you can get today. By the way, some of our members have already taken advantage of our offer of bringing a professional advisor along with you. That's the quickest way to be able to increase the net practice revenue, is by having professional advisors at your beck and call. And if you generate revenue for them, trust me, they will answer your phone call and they will talk to you politely and like gentle people. It's just a great way to do it. So you can also, if you want more information, call 877-258-2837, or you can email thecenterteam@yourctsr.com. In any event, appreciate the time and you took in listening to this today. We hope to see you at the Academy.